Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 257 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Good morning, Mark. How you doing, buddy?
I am well. How about yourself?
Doing great.
Heavily caffeinated, I was told.
Yes, I had 2 shots of espresso this morning. I have done the best I could to limit my content. I have so much content over the past roughly 10 days.
Yeah, I got a backlog.
It was really tough to dwindle it down to the list I have today.
Yeah.
So I'm going to do something unique. When we go to our articles and research of the week, I got kind of a rapid fire to see what your response is to different data points that caught my eye.
Okay.
It'll be fun.
All right. Well, let's dive right into it. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts, and as of the market close on June 19th. S&P 500 index up 4% for the month of June and up 15% on the year. The Dow Jones Industrial Average up 0.4% for the month and up 3% for the year. The NASDAQ Composite Index up 6.7% for the month of June and up 19% for the year. The Small Cap Russell 2000 Index down 2.4% for the month and flat on the year. And the Vanguard All World ex-United States ETF down 0.3% for the month and up 5.5% for the year. 3-month Treasury rate at 5.5%, the 2-year Treasury rate at 4.69%, and the 10-year Treasury rate sitting at 4.22%. Moving on to big headlines and current events from the week. First thing, Matt, is that Trump is floating the possibility of campaigning on eliminating the U.S. income tax and replacing it with tariffs on imports. So obviously, Trump is just a candidate at this point, and that's something that was just brought up this prior week. I think we both know that has its pros and cons.
Sure.
Coming along with it. Do I know how probable this is of getting passed if he does become president? Have no idea, but it's just interesting. Yeah. I know a lot of people would love to see that.
Sure.
But then the flip side of that is inflation is probably going to hang around for a little longer, right?
Oh, yeah.
Yeah. So, again, just a proposal on the presidential side of things. And the second thing I had was the Fed signaled that they will either have 1 or 0 rate hikes the rest of this year. And remember, coming into this year, it was forecasted, why I hate forecasts.
For our podcast listeners, Mr. McEvely did air quotes.
We came into the year expecting 6 rate cuts, and those are all the analysts and all the economists, right? And we're sitting here at almost the end of June, and we have yet to get a rate cut. So just, again, another example of why I don't think it does anyone any good to guess where the S&P 500 is going to be by the end of the year and have price targets on stocks and predict the number of rate cuts, because most of the time it just doesn't matter and people aren't even close. And this is one of those scenarios. So just interesting that I think the Fed is like, hey, the economy is strong enough to kind of just hold rates where they are. And, there isn't a need to provide stimulus to the economy just yet. So,
yeah, no, I said it in the podcast recently, and I want to say it again in case a listener or viewer missed that specific one. The longer the Fed holds rates where they're at, and once they make the first cut, the slower the cuts are at that point. When you look at history, the better it is for risk assets.
Right. Yeah, that's great.
Okay.
Moving on to tweets, articles, and research from this week. First thing I had, Matt, was a tweet from David Cox, CMT CFA, on June 14th. And he's talking about market breadth. So he says there are a lot of folks, technicians and non, all talking about declining breadth. Yes, for sure, fewer stocks are rising as the markets, the S&P 500 and the NASDAQ hit highs. I remind you that in 2021, it was even more pronounced. And Jenna will throw this picture up on the YouTube video and on our show notes. So what this shows is the left-hand side is the S&P 500 in the end of 2023 and into 2024. On the right-hand side is the S&P 500 back in 2021. And what you're going to see in the bottom panel, the green line, is the percentage of stocks that are above their 50-day moving averages. And what this shows is that back in 2021, we had that situation where it was just a handful of stocks pulling the markets higher, and breadth was bad, meaning not a whole lot of stocks were participating in the upside rally. And people were saying the same things, right? They're like, the market can't go any further. Breadth is horrible. More stocks are making new lows and making new highs. And you can see pretty clearly in this chart, Matt, that when we had this weak breadth in 2021, the market just kept moving higher. So it's not a situation where this is a timing mechanism to say, hey, the market's going to fall by 10 to 15% over the next month. Eventually this will have to resolve itself, but it can resolve itself by, the market's not going anywhere for a certain period of time, or it could be a correction of 10 to 15%. So I thought this was really good because, we've had instances like this in the past, and it's not, doom and gloom, world is ending.
I love that you're highlighting this because, to be very direct, I am absolutely sick of seeing articles about market breadth over the past week.
Yeah.
And all the analogies, Mark, are going back to the year 2000 of the tech bubble. And the way that they're presenting the data is insinuating this hasn't occurred since 2000.
Right.
And you are very quickly dispelling this happened a couple years ago.
Right.
And I think you are also making a very good point to our listeners and viewers that just because you have this bad market breadth doesn't immediately spell doom for the market. That these, let's call them dislocations, can stay that way for extended period of time. Mm-hmm. At a certain point, will it have to correct? Will it have to normalize as you insinuate it? Yes. But if you're predicating investment decisions on that premise, you might go another, I'm just going to pick a hypothetical, 6 months where that continues.
Right.
So I love that you highlighted this.
Yeah. And a good example of this too is, kind of what you were talking about, kind of that trend lasting for longer than people think, is we were getting, Cisco comparisons to Nvidia a year ago, saying, hey, this is getting
long in the
Cisco like, right?
Yep.
Like in the early 2000s. And here we are a year later. And over the past year, Nvidia is up like 200% or something like that, maybe even more.
Yep.
So these trends can persist for a lot longer than people think. So that's why you can't use it as a timing indicator. So next thing I had was a article from Alan Roth in Advisor Perspectives titled "Why Stock Buybacks Are Great for Investors."
Yes, they are.
So I want to start, Matt, just defining a stock buyback.
Please.
Okay. So a stock buyback is a corporate action in which a company buys back its own shares from the marketplace. So this reduces the number of outstanding shares, which increases the value of the remaining shares, right? Mm-hmm. So Alan gives an example. He says, say you own 100 shares of ABC company that you bought for $10 a share a little over a year ago. ABC has 10,000 outstanding shares, so you own exactly 1% of the company.
Okay.
ABC is currently trading at $12 a share and wants to return $120,000 or $1.20 per share to its shareholders. If it pays you a $120 dividend, you will likely be taxed at least the 15% marginal tax rate so that you will be left with no more than $102. All things being equal, the share price will drop by the $1.20 dividend, and you'll still own 1% of ABC. Mm-hmm. But if ABC instead decides to do a stock buyback, it can buy 10% of its outstanding shares. It returns the $12,000 by buying back 1,000 shares at the $12 per share price. You sell 10 shares, 10% of your 100 shares, and you're left with 90 shares. You receive the same $120, but now have a long-term capital gain of $2 per share or $20 in total. At the same 15% marginal tax rate, your taxes are only $3 and you are now left with $117 or $15 more than the dividend scenario. You may be thinking that you own less of the company since you sold some, but in reality, you are left with 90 shares and the company now has 9,000 shares outstanding. You still own the same 1% of the company. And in this article, he goes and gives an example with math to show, dividends versus stock buybacks. And I would encourage people to go read that. So really, buybacks are a little more efficient from a tax perspective. I know, dividends are extremely popular, especially for retirees looking for income in retirement. But, look at one of the most successful companies in the world, Apple. How many times have they done a share buyback? And look what the stock price has done, right?
Don't quote me exactly on this, but I'm going to get very close in the math. In 2015, they had somewhere in the avenue of, 26 billion shares, and now they're down to like 15 or 16 billion.
Right.
And they are just been on a buyback spree.
Yeah.
It's just, it's great for shareholders.
It is great for shareholders. I know it's gotten a lot of scrutiny in Congress over the past couple of years, but if you're a shareholder of a publicly traded stock and they're buying back shares, it's usually a good thing for your pocket.
Yeah.
Last thing I had was a tweet from TrendSpider on June 5th, kind of going back to what we were talking about earlier. They say Nvidia quarterly revenue growth almost as parabolic as the stock price. And what this chart shows is the stock chart of Nvidia on a weekly basis. And it also shows the, revenue growth on a quarterly basis. And this is an interesting one, Matt, because this chart here kind of dispels the comparisons of, Cisco and all these non-profitable tech companies back in the early 2000s. Is Nvidia's revenue growth is like unprecedented, and it's keeping up with like the stock price. And I saw a piece of research
this
the
is
other
not
day
an unprofitable company. They also make money.
Their valuation ratios, their valuation, depending on what metric you look at, has actually gotten cheaper as the stock's gone higher because they have the financials to back it up.
Sure.
So I just thought it was interesting because if people want to know why Nvidia's been on a rocket ship, just look at their quarterly growth rates. It's outstanding.
Excellent to point out. My words of wisdom for investors is at some point you're going to see a deceleration of their growth rate. Okay?
Yeah.
That's most likely when you see a correction in the stock price. And it doesn't spell doom and gloom maybe for, this is not a recommendation for or against, but when you see those types of corrections, that will definitely scare a lot of the hot money out of those stocks.
Yeah, and just recently, I think it was Tuesday, the close on Tuesday, Nvidia took over Microsoft and Apple for the largest company in the world.
I saw that.
On a market cap basis.
I saw that. So. My words of wisdom is these are the types of stocks, when it's this hot, 5, 10, 15, 20% corrections, nothing.
Yeah, that could happen. 20% could happen in a week.
Yep.
Yeah.
All right. I'm going to start this off with just kind of 60 seconds on a topic, see what Mr. Mark McEvely's reaction is to this data point that caught my eye. This is going to be fun. Okay. So this is going to be my first kind of piece. First one is from Bespoke Investment Group on June 13th. I'm going to read this, and then Jenna's going to put up the chart for our YouTube viewers. This will be in our show notes. Here we go. AI basket names from the S&P 500 have seen forward earnings estimates rise 38% since ChatGPT's release. That compares with 8% for the rest of the S&P 500. My take? This is why the market's focus has been AI-related stocks. Earnings growth estimates are being revised higher. Higher profit expectations has led to higher stock prices. Historically, what makes these types of rallies correct is when the growth estimates get over their skis. So your comments or thoughts to this?
No, I don't really have anything else to add, but it's just another example of, investors want to be where the growth is. And this is where a lot of the growth is right now.
So it's no
the
surprise.
same thing in semiconductors, right?
Yep. Next piece is from Frank Zorilla. He's of Zor Capital on June 12th, Mark. It's about market breadth. Wanted to make sure we talked about it because I had no idea what your show notes were going to be. Data point was 1,176 fresh 1 month lows versus 218 1 month highs, 515 fresh 3 month lows versus 123 new highs. And we have more stocks down 25% or more in the last quarter than up. So again, you're seeing the confirmation of all these stats about market breadth. Before I move on, any other final comments?
No.
Okay, next piece. Kathy Jones, June 12th. The 10-year yield drops 10 basis points, the largest one-day drop so far this year. Jenna will put up the chart very quickly for our YouTube viewers related to a Fed announcement, what you were talking about earlier. Your immediate thoughts?
Yeah, I think rates have kind of just been chopping sideways for a while, and I think investors have been kind of waiting for them to break out one way or the other. And for right now, kind of seems to be breaking down, which confirms kind of the strength we've seen in some bond prices recently. So TLT, the U.S. Treasury 20-plus year ETF, has seen some strength over the past couple of weeks. So it's kind of confirming, hey, maybe, rates do move a little lower here for the next couple of months.
Well said. I got two more in this kind of rapid fire. Next is a post from a research firm called Game of Trades on June 11th. Money market funds crossed 6.4 trillion with a T. Jenna will put up this chart for YouTube viewers. This will be in our show notes. You can kind of see the balances of money market funds going back several decades here, Mark. My comment to potentially prime the pump for you is, what happens to these funds when rates start to drop? When short-term rates drop, do you really foresee 6.4 trillion staying in an asset class that the return starts to drop? What's your thoughts?
Yeah, well, I mean, you can see that, since they started tracking this data back in, 1974, money market funds have been in an uptrend, right? So I don't think that uptrend, that long-term uptrend is going to stop, but you can see, kind of in the, 08 to 2010 range, those funds dropped, and, 00 to 04 money market funds dropped. So I would expect that people would take money out of these types of investments if rates, fall by 50%. But I don't think the long-term trend of this is going to change, especially if, we continue to have more and more government stimulus. It's just inevitable that this is going to continue to go up, I think. But, interesting. I think you're just going to see money rotate.
Well said. I have nothing to add. Last in the rapid fire is a chart from Bar Charts on June 12th. It's about global container shipping rates. They are really moving to the upside again. Prices are 181% higher than they were in the same week last year. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. Mark, what do you kind of make of the dynamics of what's going on in shipping right now worldwide?
Yeah. I think that, we're just kind of in this new environment where, prices are just going to stay elevated. And I think people need to be okay with that. I mean, as you can see on this chart, we did have a pullback in shipping prices. But, like we kind of say for everything else, when you have like a big inflation storm like we've seen over the past couple of years, prices usually don't ever go back to the levels they were before, right?
Well said.
And I think,
well said.
People are like, well, shipping, it's like all supply and demand. The prices have to come back. And it's like, not necessarily. If people are going to continue to pay it, why would the shipping companies lower prices?
Yeah, and I'd argue, I don't have the stats to back up this comment. This is an opinion, but I'd argue that I bet you there has not been a lot of fresh ships built to add to the amount of supply.
Right.
I'd argue that.
Yeah, the capacity's not increasing.
All right, I got two more things I want to run past you before we convert to the financial planning topic of the week with Taylor. First is an interesting chart. This was posted by Mike Zaccardi, CFA CMT, on June 11th, Mark. This chart is the source's Bank of America Research Investment Committee in Bloomberg. And what it does is it overlays CPI, or the Consumer Price Index, from 1967 through 1985, and it overlays it from CPI 2014 so far here through 2024. And what you're going to see is a very high correlation to the run-up in inflation we saw during the pandemic, and it came back down. Well, what do you think is happening? Because this is not the first time I've seen this chart. People are worried about inflation getting reignited over the next couple of years, similar to what happened in the late 70s and the early 80s. What's your thoughts when you kind of see these charts? I know it's something that Wall Street's going to be monitoring, but when you see this, what goes through your head?
Yeah, two comments. I usually don't love charts like this because, when you have hundreds of years of data at your fingertips, you can pretty much make any chart look the way you want it. So, you can kind of cherry pick the data. And an example is, I can use the past 50 years worth of price data and create, one of the best investment models back tested that we've ever seen. But at that point, I'd be what we call in our industry curve fitting and over optimizing based on what happened in the past. Now, will things in the future look similar to the past? I'm sure, yeah, on certain occasions, but you can't expect just because price acted one way during this decade when A, B, and C was going on, it's going to look the same in the next decade when we have similar situations. The other portion of this is it is pretty scary how closely this chart is tracking. So we'll see, but
next year or two will be interesting, and I don't disagree with what you're saying.
It will be, and I do like reading pieces like this, but I just don't love it from a viewer or prediction standpoint. Although the correlation is pretty high in the environment we're in now compared to 67 to 85.
Yeah, my biggest point when I see this is, especially when I'm talking to clients, it is going to be extremely difficult for the Fed to get inflation under 3% when the government is spending money like a drunken sailor.
Yeah. I mean, that's the entity that gets hurt the most, right?
Yeah.
Because they got to dole out all those, all those interest payments on their debt, right?
That's right. All right, I got one more. It's about the jobs market. This is not a full-fledged concern of mine, but it's definitely an area I want to watch. First is a chart of U.S. full-time employment. The source on this is Tava Costa. He is Crescent Capital's a macro strategist, I should say. And this post was from June 7th. And what it will show is U.S. full-time employment, year-over-year change, and the data set goes back to 94. And the reason I'm highlighting this for our listeners and viewers, Mark, is if you start to go under the hood of the car, there's been job gains in part-time jobs, but there's been losses in full-time employment jobs, especially over the last 3 months, okay? This chart highlights that. Doesn't necessarily spell that a recession is imminent, but definitely is something that I think we should take note of. In addition, I went ahead and I went to the St. Louis Fed site, the Fred data. We talked about it in the podcast before. You can get it. Any of our listeners and viewers can Google the St. Louis Fed. And I got that from June 8th. And I wanted to look at the JOLTS, or the job openings data. And I've talked about this over the years, especially during the pandemic. We're approaching almost 5 years of the podcast here. So there's a long track record of me talking about this stuff. You're definitely starting to see these job openings come down to where they were pre-pandemic, okay? And I just want to kind of highlight that as these job openings come down, employees, they have less of an option. You see the power starts to move more towards the employer. And, the question is how many of these job openings continue to dry up? And is it a factor of AI? Is it a factor of demographics with the baby boomers continuing to retire and companies are like, I'm just not going to replace the position? I think there's a lot of cross currents in the data. And I'll be curious to see over the next 6 to 12 months how this pans out on the employment front. But last 3 or 4 months for me doesn't give me the warm and fuzzies.
Yeah, and I think it's not really garnering a lot of headlines right now because I think there's so much else going on in the world today in regards to the stock market and financial media. But there has been a tick up in layoffs, at least that I've been noticing, especially during earnings calls. Like companies like to slide it in there after they say, oh, we smashed earnings and revenue estimates. We're raising our guidance. And we also laid off 2,500 people, and they just kind of, shoo it off type of thing. And that's not getting talked about.
I agree, sir.
But if that continues, I think it will start to be a more popular thing to talk about in our industry. But I agree, especially with the job growth or openings that we've had since COVID. Like you said, that pendulum is now swinging back towards people not having as many options and flexibility anymore. And we know that pendulum over the next 3 decades is going to continue to swing back and forth, but I would agree that it is going back the other way right now.
I definitely think this is a topic that people need to pay attention to over the next 6 to 12 months. Employment's going to be very important. And this is another reason why you want to be a consistent listener of the Independent Advisors podcast.
That's right.
Before we transition to Rockstar Taylor Ledbetter on the financial planning topic of the week, Mr. McEvely, anything you would like to end with before we transition, sir?
No, I don't think so. It's kind of hard to believe that we're inching closer and closer to the end of Q2. Right now, it seems like we just had earnings season not that long ago, and within the next month, we're going to have
starts all over again, baby.
Earnings season starting back up again. So, no, I don't have much to add.
I'll just add this while you're here. Listeners and viewers, a lot of companies are in what we call their blackout period. So you're not going to hear a lot of news from companies leading up to their earnings announcements. So I think the news flow company-wise could be on the low end over the next couple of weeks.
Yeah, which isn't a bad thing.
Not a bad thing.
So,
all right, we're going to transition. Thank you, Mark. So next up, we have Taylor Ledbetter. She is our firm's paraplanner and specializes in financial planning. So Taylor, welcome to the podcast. How are you doing this week?
I'm doing good. How are you?
Good. Nice to have you back on. I know that last couple of weeks, just time did not permit to have you on. I know you had a couple topics teed up. What did you select for us this week?
Yeah, so today I just want to talk about, all the different retirement accounts out there, what you should prioritize, saving to which account, how much.
Love this.
Because it can be overwhelming with so many different options.
And this is great, Taylor, because I think a lot of times, and now I'm going to use myself as the example. I think at times people in our industry take for granted that clients or prospective clients just know the difference between a Roth and a traditional IRA, right? So this is going to be fun. I'll let you run with this.
All right, so today I'm going to be referencing an article that I read from the College Investor, and it's called The Best Order of Operations for Saving for Retirement.
Okay.
So the first account they recommend contributing to is just an employer plan through work. So that could be a 401k, 403b. Those are the most common that we normally see.
Correct.
And the article recommends contributing enough to take advantage of your employer's match. Okay,
I agree with this.
Yes, me too. So obviously every company's match can be completely different. I've seen 3%, 4%, 5%. But the article says if your company matches and you don't contribute, you're leaving free money on the table. It's essentially giving up a percentage of your pay. And they included a fun fact. They said 25% of employees don't save enough to even reach the match.
Yeah, and that's surprising to me. I think it's just a lack of education. I know that these companies, they send out something called the summary plan description, and it's kind of like the Cliff Notes version of, hey, here's the fun facts about your retirement plan. And you just kind of hope that they look and say, okay, how much do I have to put in to get that full match? But you and I both know it doesn't work that way.
Exactly.
Yes.
Yep. So I did agree with, the order definitely at least contribute up to the match for that first account.
I'm with you on this so far.
And then the article says once you contribute enough to get that match, they recommend doing a Roth or a traditional IRA up to those annual contribution limits.
Okay.
So for 2024, that contribution limit is $7,000. If you're age 50 or older, that limit goes up to $8,000. And something that some people might not know is that you can contribute to an IRA up until the tax deadline of the following calendar year.
Excellent point.
So normally April 15th.
Excellent point. So to say it in my own words differently, you can make that contribution in April for the previous year retrospectively. You have until April 15th to do that.
Correct.
Yes.
Yep. So, and you can do, technically, if you're doing a prior year contribution like that, say you're under 50 years old, you could do, like you said, $7,000 for the prior year and then still contribute $7,000 for the current year, even though it's technically in the same calendar year.
Makes sense. Makes sense. Yeah. You can double up at that point.
Yeah.
Yep.
And I would say they probably recommended these IRAs as the next option, I think, because of the investment flexibility that you have in IRAs.
Good point.
Whereas obviously employer accounts, you're limited to your investment options.
So saying another way in my words, through that 401k or 403b, hey, Taylor, here's a list of 20 investment options. You can only select from those 20 compared to if you have your own personal Roth or traditional IRA, you can custodian that virtually anywhere. And a lot of those custodians have thousands upon thousands of investment options you can select from, right?
Right. Yeah. And sometimes employers, they do have good investment options, but
Yeah.
I've also seen some that are pretty poor.
Yes, it's interesting how it comes across that way.
It
Because
is.
some are just so good and size of company doesn't matter, right?
Right.
We've seen large companies that from our opinions have poor plans and vice versa. There's no rhyme or reason with it.
No. So just my last comment on the IRA side, we typically recommend contributing to a Roth while you're still working if you expect your income tax rate to go up when you retire. Because while you're working, if you're in a pretty low bracket, maybe you're in your 20s, early 30s, you're probably in the lowest tax bracket you'll ever be in.
Yep.
And that's just going to go up. So we would rather you do a Roth, pay those taxes up front.
Yep.
So it's tax-free later on.
I agree.
And vice versa for the traditional
Traditional.
IRA. So after the IRAs, this article recommends maxing out your 401k up to that annual limit.
So going back to it if funds allow.
Correct.
Okay.
And the annual contribution limit for the 401k is $23,000, and if you're 50 or older, it's $30,500.
Correct.
So they call that a catch-up contribution for ages 50 and older.
Yep.
And then after you have maxed out your 401k, the article talks about contributing to an HSA. Now, they said the only reason they put the HSA as number 4 on the list is because a lot of people might not qualify for it.
Yeah.
So to be eligible, you have to be part of a high deductible health plan.
Correct.
And employers who do offer an HSA, many times they do match those contributions. And sometimes the health insurance attached to the HSA is cheaper than other options that are offered.
I like that you're highlighting this. we're at the point now where people can, if they so choose to do so, invest these balances beyond just keeping them in cash or a money market option. I know that's starting to gain popularity over the last couple of years as well.
Which I think is great because, obviously medical expenses can be really high.
That's right.
So just saving in a normal account versus investing those funds, you're going to cover a lot more ground.
I agree. And I know it was on the podcast, it was over the past year, Mark was talking about HSAs, and it might have been you, Taylor, so I apologize if it was. And he made the comment that a strategy he's seen people talk about is catalog expenses, keep the receipts, and in retirement, that you can then file those receipts to get tax-free funds out of your HSA for expenses that you incurred while you were working. So it's definitely, I'm not sure if it was you or Mark.
Might have been Mark.
But it was definitely a wise idea that if you're, hey, in those last couple, high income earning years, you really don't need to get the money out of your HSA yet. Let that money grow, invest it, and then in retirement, kind of send those receipts in and get your money out tax free. Not a bad idea.
Yeah, no, that's great, especially if you're trying to max out that contribution every single year.
Well said. Well said.
So after all of those 4 accounts have had contributions to it, this article recommends investing in a standard brokerage account. So brokerage accounts are technically not retirement accounts because there's no tax deferral or tax-free breaks.
Yep.
But it's important to invest versus just saving into a normal savings account or money market fund.
The way that I like to verbalize this so people understand very simply is just think of it as a checking or savings account, but instead of the money just sitting in cash, you can invest in a mutual fund, a stock, a bond, a commodity. You can virtually do any type of investment inside that after-tax brokerage account.
Right.
Good way of saying it?
Yep. And, brokerage accounts, they're technically not retirement accounts.
Correct.
So there's a lot of flexibility. I've seen people use these accounts to save up for a big purchase, like down payment on a home, car purchase. And obviously, these types of accounts are taxed differently than maybe a 401k or IRA would be.
Correct.
So if you do have a mixture of all of these accounts, you're able to manipulate your tax bracket in retirement.
Very well said. And I'll throw it out there. Typically, the more money you make or the higher net worth an individual has, the more portion of their liquid net worth are going to be in these after-tax type of accounts. Why? Because of the contribution limitations you just went over of all of the tax-deferred types. Right? So there's just that correlation that we see within our practice. The higher the net worth, liquid net worth, I should say, the more they're going to have in these standard brokerage type accounts, right?
Right. Yeah, because the brokerage accounts have no contribution limits at all.
Absolutely.
So like you said, if you're a high income earner, you're already maxing out the IRAs and 401ks. That's kind of the next vehicle to add.
Well said.
But yeah, I agreed with, the order that this article recommended. I think more people do need to take advantage of that match in their employer account. But I think it's really great to have a mixture of all of these.
I love that you highlighted this. This is good. Order of savings. I like this. Couple things for our listeners and viewers. If you want to create your own podcast, we use Blueberry as our podcast hosting site. You can use the promo code JessupWealth to get your first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month free with promo code JessupWealth. That's all lowercase, no spaces. In addition, we are using AI, Taylor. If you are looking for an AI software to help you note take, summarize a meeting, plan your action, needed tasks, we highly recommend Firefly's AI software. We use it to summarize the podcast every week. Use the link in the show notes below to purchase your subscription and make life a little bit easier. Before we sign off on episode 257, Taylor, any final thoughts on your end?
No, I don't think so. It's just good to be back on after a while.
It is great to have you back. Quarter's almost over. We got one more podcast, and then it's going to be the end of the second quarter of the year. It's flying by. So thank you, everyone, for listening to episode 257 of the Independent Advisors Podcast. We'll be back next week for episode 258. Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.